should imagine all eyes really on the MPC this week, and I think it's a foregone conclusion that we are going to have the repo left at 5.5%. What are some of the factors they're going to be considering as they go into that meeting?
Well, Stephen, you're absolutely correct, 100% there. There's no surprise expected on the actual outcome of the meeting. Everyone's expecting 5.5%, but rather where you could see some surprises, and what the markets are really going to be concentrating on is the tone of the statement, and very, very importantly, the wording. Because what we did see in the last MPC statement was an upward revision to the inflation forecast at the Reserve Bank. However, you must remember that between the January MPC meeting and the last one in March, the oil price in both Rand terms and US dollar terms actually moved up in excess of 20%. This time around, since that last March MPC meeting, we've actually seen a very modest climb up, no matter which unit you're looking at, of between 3 and 5%. So from that perspective, we're not actually expecting any huge significant revision to the Reserve Bank's inflation forecast, if any at all, for that point. But rather, what I think is very important is that the last MPC statement showed the shape of the Reserve Bank's inflation profile, which showed inflation to peak in the second quarter of next year, but then actually taper off, which would suggest inflation slowing down into 2013. If this tail end, so in other words, their fourth quarter 2012 inflation forecast had to move quite significantly, well, that would create quite a difference in market expectations for interest rate decisions going forward.
Do you think we're going to breach that target at some rate between now and 2013, so where they're looking to at this point?
Well, we actually think that going into the first quarter of next year, we get very close. We almost hit 6%, if not going up it for just a moment. However, after that, we believe, much like the shape of the Reserve Bank's profile at the moment, we will actually taper downwards. Now, that's very important because, remember, we do believe that interest rates will go up. The market may think it'll be in November 2011. The FRA curve's fully pricing this in. We actually think it'll be in March 2012. But when we say we're expecting rate hikes of around 250 basis points between January and September next year at 50 basis point increments, well, that's what we think the SARB is going to be looking at for normalization level. Remember, when they start to hike, it won't necessarily be to curb inflationary pressures like in the previous cycle. Rather, they'll need to get that interest rate, in real rates specifically, up to some form of a neutral level where they're neither too restrictive nor too stimulatory, so that GDP can carry on a more sustainable path.
Would 8% for the repo rate then be for you a normalized level?
Very much so, according to our calculations, but there is a lot of debate around the market in this regard. I think if you have conversations with anyone in the markets, I think it's ranging at the moment anywhere between 150 to about 250 basis points. We are certainly on the more bearish side that rate hikes will be slightly higher than people are expecting. But I think what is very important is that because this economic cycle, particularly if you compare it to before the previous rate hikes in that 2006 cycle, this economic cycle, even if you just look at the consumer, is a whole lot weaker than before. So the important point I'm getting to here is that the peak that we're expecting in the upcoming hiking cycle is a whole lot lower than the peak of the previous cycle, which makes sense. Why? Because household debt hasn't really deleveraged. So consumers should be almost as sensitized to a peak of 8% for the repo rate as they were in the previous cycle at a lot higher level.
Let's look at some of the other factors they might consider as they go into that meeting. We had the unemployment rate out last week, 25% ago, so getting a little worse there. We also have manufacturing data coming out this week, and according to your preview, you're expecting a slight deterioration in manufacturing between February and March, and I'm sure going into April with all those holidays it's going to get even worse.
Well, it is unfortunate that it is set to slow down to about 3% according to our calculations. 3% growth isn't anything to get too excited about. At least it's in the positive territory. But nonetheless, if you look at manufacturing production, remember the data is 2 months old. I mean, we're looking 2 months back. And what the SARB is going to be concentrating on really is the leading indicator in the PMI, which although is moving ahead, remains only just out of expansion territory. And I think the point there, if you take that alongside those unemployment numbers, which really is also not painting a very bright picture for the economy, if I get back to economic growth, and remember, I think the difference between economic viewpoints on when the hiking cycle is going to begin depends where you're putting the weight, more on inflation, more on growth, or quite equally on both. We put it quite equally on both because we think this economic cycle is very uneven in nature. And it's because you've got that Achilles heel of not many jobs created at all since the recoveries began. And then, of course, credit growth remains very muted. On top of that, investment is hardly anything to speak about at the moment. So even if you just look at those parts of the economy, not to mention the fact that the consumer is actually not stronger this time around than it was last time, well, it doesn't really give us much reason why they should start to normalize rates this year when they could hold out, tolerate those first round effects, those first round fuel, food, etc. Core inflation is still at 3.1%. So we think it'll be justifiable to hike rates, but only a little bit after the market is actually thinking.
Well, something that might give the Reserve Bank a little bit of leeway is the rand still trading pretty firm at 6.76, although we have seen a bit of softness in the past couple of days. So that's going to help them. We had golden forex numbers out today. Has there been much evidence that the SARB has been taking advantage of this strong rand going into the market and mopping up excess liquidity?
Well, we think so. I think the reserves numbers that came out today for April showed that there was actually a little less intervention by the SARB than expected from simply anything other than the valuation adjustments thanks to FX, and then of course the gold movements that we saw. So yes, we think the Reserve Bank at the moment, given that the oil price did tick up quite sharply over the last 3 months, is actually quite willing to tolerate a rand as strong as it is at the moment because it's really helping that inflationary impact. And once again, if the economy hasn't fully recovered to the point where anyone is completely happy with it, well, you don't want to be hit by any undue pressures coming from fuel prices, which is really out of control when it comes to consumer spending.